Hello, this is Mould on Markets. I'm Clara Hermit, and joining me, as always, is our investment director, Russ Mould. Russ, how are you?
Very well, Clara. How are you?
Not too bad
Good.
at all.
Pleased to hear it.
Russ, what is it that advisors and their clients should be thinking about at the moment?
I think the big issue right now is another round of government economic pump priming. Whether it's government or central banks, they're all at it. And I'll give you three really quick examples. The first is Japan, where the Bank of Japan has doubled down on its quantitative easing scheme, massively increased it to 80 trillion yen a month. That's basically 3/4 as big as the US scheme that's just finishing, for an economy a third as big. Secondly, China at the APEC conference looks to be getting a little bit worried about its economic prospects. Xi Jinping announced the plans for a new Silk Road, a $21 billion domestic rail infrastructure program, and a multi-trillion-dollar international scheme linking it all together. And then in the UK, Prime Minister David Cameron front-ran effectively the autumn statement on the 3rd of December, talking about a £15 billion motorway scheme. So, a lot of governments clearly getting a little bit edgy about growth, a little bit worried, and this is all before December, European Central Bank's targeted long-term refinancing operation, second round of cheap cash for the banks, and also whether the ECB itself goes for QE. We'll find out.
Okay, so what does that mean for clients' portfolios?
Well, I think Japan is probably the easiest one to illustrate because it's the most immediate, and the chart behind us shows it immediately. You've got the Nikkei 225 index, and you've got the sterling yen exchange rate, and it's pretty clear. Nikkei 225 has gone through the roof. Sterling yen, well, the yen's gone through the floor, and sterling's gone up against it. And it's pretty easy to understand why. Not only is the Japanese central bank now flooding Japan with very, very cheap money, on the same day as the announcement, the Japanese government pension fund announced it was doubling its equity allocation. So, you've got this tidal wave of cash flooding into Japanese stocks, yet at the same time, all this money printing going on, weakening the value of the yen. So if any clients are excited by what's going on in Japan, certainly when they talk to their advisors, they need to think about hedging their yen exposure, because it does seem as if the yen is going to keep on going down. The chart's a very ugly one. And you can do that through some active funds, which offer sterling-denominated share classes, or ETFs will also hedge that out. I mean, there are no guarantees with the foreign exchange market. Mervyn King, the former Bank of England, once said only a fool would try and predict foreign currency movements, so I won't. But what I would say is that although the sterling yen's gone from 168 to 182 this year, 2007 sterling yen was 250. So history suggests the yen, if it really gets going, could go an awful lot lower from here.
Okay, Russ. But are there any broader implications? Because not everyone might want to get involved in Japan, even after a 25-year bear market.
It's been a bit of a disappointment. I can understand that. I think one thing I'd be intrigued to know is, how are all these projects going to be funded? Well, it's palpably obvious in Japan's case. It's money printing and more debt. And adding more debt to a situation that's created by excess debt, well, it's where we are. I mean, that's about all we can say about that, really. But I think what it does suggest is that central banks aren't going to be encouraged to jack up interest rates in a desperately great hurry. Even if the US and UK have put their quantitative easing programs on hold, it feels like Europe and Japan are going towards looser policy that won't be helping the Americans or the Brits tighten, because they won't want their currencies going up and economies slowing down. So I think it just puts this constant emphasis on interest rates are going to stay low. Fixed income, a surprise this year, may well continue to do so in that environment. And again, the reach for yield through equity income funds will probably continue.
Okay, Russ, thank you.
Thank you.
Thanks for joining us. We'll see you next time. Goodbye.